this is for the 2023, our first introduction to finance. For those of you joining in, Kevin, how's it going from South Africa? We've got Brian in the Midwest. A few people, I'm guessing we've got a few other people in listening. So great to hear you guys and see you guys. I hope you enjoy it. The 2023s, we're going to start with conservation finance. You guys here? When you use the word guru, it's somebody who knows a lot of stuff. I think Ricardo Bayon is one of the, if not the guru on conservation finance. So it's an absolute pleasure to have you, Ricardo. Ricardo's been involved with Kinship for 10, 12 years or more, no? 15 years probably. Plus the faculty that he was on the advisory council for a long, long time. So he knows all about Kinship Fellows, all about you guys, and has been able to explain finance in simple words to generations of Kinship Fellows. So hopefully you'll get it as well. So Ricardo, it's always wonderful to have you. Thank you very much. The floor is yours.
Thank you, Nigel. So now that he has totally oversold it, I will go to underdeliver after that overpromising from Nigel. Yeah, well, I'm sorry I can't join you guys in person, not least of which because that's such a beautiful part of the world this time of year. So hope you're enjoying it. The way I wanted to structure this is to make it pretty open. So if you have a question, raise your hand and maybe somebody can let me know if I don't see you. I want this to be much more interactive, as much as interactive as is possible given this medium. But I also wanted to talk about a couple of different things. So I don't have any problem with you interrupting me. I don't have any problem with going off track. I would rather not cover everything I have because I've built a long PowerPoint for you. I can induce a deep state of PowerPoint narcosis in all of you if you let me. So please don't let me. Stop me, interrupt me, ask questions. If there's a particular aspect of the world of finance that you want to talk about, that you want to go into, that you're curious about, chances are others will also be curious about it. So please ask the questions. So the structure I have is to tell you a little bit about myself and why I think conservation will not happen until we understand the real basics and intricacies of the financial system. And why, it's not just about biological sciences. It's not just about policy and politics. It's also about this system we've created, which I believe is one of the most powerful tools humans have ever created, and how it works and how it affects things both for good or for bad. And so I'm prepared to go into really the depth and basics of the financial system. And that means taking a look at, what is money? How do we understand money in finance? But also looking at things like debt. Well, how does debt work? What are bonds? How do they work? Equity, stocks and stock markets, and how do they work? And then putting it all together to look at some of the biggest players in the financial system, whether it's hedge funds, venture capital funds, insurance companies, sovereign wealth funds, et cetera, et cetera. And my hope is that at the end, you will have a much better understanding of this financial system. And maybe you'll begin to, read newspapers or blog posts or whatever it is that you read or view on the internet or wherever a little bit differently, because I think understanding this will help you understand not just why conservation is where it's at, why it's working or not working, but also maybe, and this is the real hope, how to actually make a difference and change things using these tools. Because just as these tools are very powerful and are a powerful barrier to getting to where we want to get to, they can also be a very powerful tool, point of leverage to get to where we want to get to. So with that, I want to, before I get going, I want to ask for a show of hands. First, I would love to know, where you fit in one of two categories. Category one is, I think I understand finance, but, not that much. I get some of the issues, but, never really thought deeply about, bonds and debt and equity or what have you. So that's category one. Category two is, no, I really think I understand finance, I've worked at a bank. I understand how debt works. I understand how bonds work. I feel very, very comfortable with the tools of finance. So, all right, how many of you are in that category one? Like, sort of understand it, but not really. All right. Okay. How many of you are in that sort of second category? You know what? I think I've got a real handle on these things and understand how the financial system works. I'm seeing one. Are there more than one? Because I only see half the classroom. Three. Okay. Good. So I think I will then go deep into sort of the basics of it, because I think it'll be useful for you going forward, not just for this kinship program, but beyond. And let me see. I want to share my screen. Can you all see that now?
That's brilliant.
Yeah, you guys all see it. That work?
Yeah.
Good. So a little bit about me. I'm a partner and co-founder of a group called Encourage Capital. And at Encourage Capital, we're an impact investment firm. And we sort of approach impact investing slightly differently, I think, than a lot of people out there, in the sense that, we start from the impact side of that phrase, impact investing. We ask ourselves, what is the thing you want to change? What is the big social environmental issue that you want to impact? And then we ask ourselves how to finance that change. How do we use the tools of finance to finance that change? And we followed this logic on a number of different issues. We've looked at climate and carbon. We've looked at energy. We've looked at plastics. We've looked at marine issues. We've looked at, a host of different issues, and sort of tried to figure out, all right, if this is the problem you would like to solve, how do you use the tools of finance to solve it? How do you create solutions that generate capital, that bring capital to the table, that make a return for investors, but that also help solve the problem? And I think what you find is that there's a lot of groups out there that take the opposite approach and sort of say, hey, we finance this, or we finance that, or we're in venture capital, or we're in private equity. And how do we layer impact into what we're already doing? So it's a slightly different approach that we're taking. Before that, I helped start another financial firm called Echo Asset Management Partners, which became Encourage. Before that, I helped set up a thing called the Ecosystem Marketplace, which was really about trying to understand emerging markets for ecosystem services, whether it's carbon, water, or biodiversity. Wrote a book about voluntary carbon markets. So if you want to go into a deep tangent, I know you've already heard about carbon markets, but if you want to go into a deep tangent about voluntary carbon markets, I can do that. Also wrote a book about biodiversity offsets, and also helped to write a bunch of articles about water and other issues. So we can draw on some of that experience out there. So, I think a lot of people think about finances like this. They sort of say, my broker jumped out of a window, but that's small consolation. And it's really just about what our portfolios are doing, if you own shares or something like that. Or at least, maybe this is how others who own shares think about things. And I think it's deeper than that. First, I want to say that we live in a very, very different world than, hundreds of years ago. We live in a world where this map kind of, for me, crystallizes the impact we're having. This only shows sort of roads, air networks, shipping routes, urban areas, and you get a sense of how we have been busy spiders covering our planet in webs. And that there's very few dark places left. And what are those dark places? Those are places that are relatively untouched, and most of them are still touched, but relatively untouched by our our work, and we tend to think of them in sort of traditional economic thinking as these are not productive areas. These are, the forests and swamps and deserts that don't really do that much for us. And I think that it's kind of in many ways the other way around. And the problem we have is that we don't think about what these darker areas signify and what they bring to us, right? So we look at the world as, development and technology is what we produce. It's our, iPads and computers and the internet and Twitter and Tesla and, whatever it may be. When you think of technology, it's what we build. And yet these natural areas are a technology of sorts, right? They are millions and millions of years of evolutionary knowledge, and what they do is they provide our life support systems. We are on a spaceship. It's a big spaceship, but we are in a spaceship, and we have systems for life support. And it feels as if we're kind of tearing apart our life support systems for parts to sell the parts. And in a way, that's what we've been doing. We've been taking from these natural systems and destroying them and using them to make money. And why is that? And so I started off much of my work in the environmental work. I worked with, you name the conservation organization, IUCN and others. I've done work with most of them. And I spent a lot of time, and we were spending, tens of thousands, if not hundreds of thousands of dollars to protect an ecosystem somewhere, a wetland in Africa or a forest in Latin America or whatever it was. And almost invariably, there were people who were spending millions of dollars to build a dam or a logging concession or whatever it may be that was kind of making all the stuff that we were doing a little bit obsolete. So I started asking myself, why is it so easy to raise millions of dollars for one thing and so hard to raise thousands of dollars for something else? And so, there's this famous quote of, they once asked the bank robber why he robbed banks, and he said, because that's where the money is. And I think of it that way, like, why is a conservation, somebody who was, the entire career is based on conservation, why are they working in finance? And it's a little bit because that's where the money is. And to me, money is really a source of leverage, a source of power. And what it indicates is energy. It is the system we use to sort of tabulate energy and interest and attention. And if we do not channel that energy and interest and attention to protecting those life support systems, then I think we have a problem. And I think we have a problem because this is another quote that I came across that said, if you think the spider webs in the previous slide were bad, this says 75% of the infrastructure that will exist on the planet in 2050 has not yet been built. Okay. So, we're only 25% of the way there. And look at the world we're living in. And look at the, wildfires, floods in the news every day. All of these impacts are going to start to be felt more and more. And honestly, I think a lot of us thought, okay, we're going to start feeling these impacts in another 10 years, maybe. And it turns out we're feeling them now in a much bigger way than people realized. And so I think there's a couple of flaws in our financial economic system. One, we don't value nature. We don't see or pay for the services it provides. It doesn't show up on people's balance sheets. So, imagine if we didn't have to pay for electricity, we'd overuse it, and we wouldn't have any money to invest in the infrastructure that delivers that electricity, right? And we are in that same situation with natural infrastructure, the infrastructure that delivers so many of the life support systems, whether it's food, air, or water. We don't pay for many of those services. We don't see them. And then we don't have money to invest in the infrastructure that delivers them. I think, secondly, we don't learn from nature or natural systems enough. We could do a lot more with that. But I want to focus on that first flaw, right? If we are really not seeing or paying for a huge host of value, that is a problem. And why are we here? Why does it work that way? I think part of it, honestly, is that the financial system we're still working with was developed hundreds and hundreds of years ago for a time and an era that was very different. It was a time when what was scarce was capital and labor. It was resources and people to essentially, tear down the swamp and get rid of all those malaria-causing mosquitoes. And that's the mindset that's kind of built into the system. And I think we live in a very different world now. We live in a world where what's scarce isn't capital and labor necessarily. We have a ton of both. As a society, it's not evenly distributed, and that's part of the problem, but we have a ton of both. And what's scarce is increasingly natural resources. And scarcity drives value. And so I think we're gonna have to transition into a world where value is ascribed to these ecosystem services. And if you're an economist, you talk about externalities. These are external to our economic system. So, what do they look like? There's a lot of studies out there. There was one that was done, maybe now 15, 20 years ago, which sort of tried to categorize the ecosystem services, the services we derive from ecosystems, into a series of categories. One is the provisioning ones. So the ones that give us the food, the fiber, the genetic resources, fresh water. I think on the food and fiber, we know how to value that. That is something that does have a value in our economic system. Then you have cultural services, and these are the spiritual, religious values, aesthetic values. Don't think our economic system does a particularly good job of valuing these, though they do show up, right? Ecotourism or paying more for an apartment with a nice view as opposed to one that has a bad view. So, some of the aesthetic values do show up. The one that I think we're very bad at and have been very bad at is these regulating services, whether it's, climate regulation, water regulation, waste treatment, pollination. All of these don't really show up in our economic system. And as a result, we underpay for them and undervalue them. And, you have the age-old example of studies that were done for a coffee farm in Costa Rica or water in New York City or what have you, where essentially they said, okay, well, let's figure out what services a coffee farm is getting from an untouched forest next door. And how much does it produce versus, places that are farther away from the forest. And, the studies that were done show that there's a huge amount of value that coffee farm receives through pollination and other services that the intact forest provides it. But really nobody was seeing it in that way. So, the value that our economic system sees is to tear down that forest, turn it to cattle or log it, because that value does show up in the economic system, right? But the value of the pollination services and all the other ecosystem services didn't really show up. And so I love this quote by Oscar Wilde is, a cynic is someone who knows the price of everything and the value of nothing. And I think in that way, we've become a bit of a cynical society. We know the price of a lot of things, but the value that we get from a lot of these things, I don't think we do. And it's not just about economics, because I also like this quote by George Bernard Shaw, who said, if all economists were laid end to end, they would not reach a conclusion. And there's another apocryphal story. I don't know how true it is, but I think it was Truman, President Truman in the US, who gathered his advisors and he said, gentlemen, because at that time they were all men, I want a one-armed economist. And they were like, a one-armed economist? Why do you want a one-armed economist? It's like, because every time I ask an economist what I should do, they say, on the one hand, you can do this, and on the other hand, you can do that. I want somebody to tell me what I actually can do. And, the truth is that, we could send teams of economists out there to tell us what is the value of a ladybug or the value of a forest. And they would probably come up with numbers, and they would probably come up with dozens of numbers. But that's not really the way our society works. That's not the way finance works. The way finance works, it's about supply and demand. It's about what is it you want? How badly do you want it? How do you want it vis-a-vis something else? So would you rather have this or would you rather have that? And it's millions of those decisions every day that send signals. And then there's signals sent from the producers, and the producers are sending signals of like, it costs me this much to, plant my coffee farm. It costs me this much to irrigate it. If I irrigate it, it costs me this much to process the coffee. It costs me this much to send it. All those signals get bundled into a price that sends a signal to you. Are you willing to pay for your, in the United States, $4 latte at Starbucks or wherever you buy your coffee, right? And I think people don't really look at it that way, and they don't think about kind of what is the power of that system. Honestly, it's one of the most powerful tools humans have ever invented. Really, when you think about it. And it's the first sort of digital system that I can think of. Because what we started to do is, set up tokens, i.e. money, currency, seashells, gold, whatever it was, that kind of held value, that signified value. And that allowed us to do trading even in ways that weren't possible before. Why? Because say you're in a barter system, right? And you grow chickens and you want, I don't know, you want some sort of fruit. But the person who's growing the fruit doesn't want your chickens. What do you have to do? You have to like find somebody who wants your chickens and have whatever it is they want either be wanted by the fruit person or by somebody else who the fruit person wants. So you're having to go through this very inefficient and ineffective system of transferring value in the form of whatever it is you've got and whatever it is the person that has something you wants. So I guess another great definition of money that I've seen out there is that it's frozen desire. It is really a token of what it is we want and desire and our ability to actually get it and the resources we have to get it. So it's an incredibly powerful system, and it has brought us a lot of the things we take for granted, from electricity to cars to computers to technology to space travel to food from halfway around the world in seasons where it wouldn't normally grow. A lot of those things are made possible by this economic system. But again, the problem is that economic system was built a long time ago in a very different world. And I guess if you're thinking in terms of operating systems, imagine what would happen if you were running Windows 95 in today's world with Twitter and internet and TikTok and YouTube and a million other things that we do with our computers and Zoom or what have you. It just wouldn't work. It would be, you would have, I don't know how many of you are old enough to remember the blue screen of death in Windows 95 computers when it would crash. You would be having these crashes all the time. In the economic system, we're actually running not Windows 1995, we're running Windows 1695, if you can believe that. Yeah, it's been patched and we fixed this or that, but it isn't, totally updated. It's literally been patched here and there. And so we're still getting the blue screen of death when it comes to things like ecosystem services, environmental systems, social systems, all kinds of things. It's not a perfect system. In many cases, not even a good system. And, I kind of think of like I think it was Winston Churchill who had said, capitalism is the worst of all possible systems except for all the others. It's kind of like, the best of the worst, as it were. And I think it's also the problem we have is that there's a certain amount of hubris, right? There's a certain amount of like, if humans invent it, then it's real, then it's technology, then it's worth something. Whereas if natural systems provide it, well, that we don't take for granted, which is why I love this quote. It says, irrigation of the land with seawater desalinated by fusion power is ancient technology. It's called rain. And just imagine if we messed up that system, which we're in the process of doing. Those technologies are fundamental to our everyday life. But, and this is a big caveat, markets and market systems and financial systems aren't perfect, and they aren't the answer all the time. It's sort of like this. Look, all I'm asking is that we let market forces bring a greater degree of efficiency into our marriage. As someone who's tried this a time or two, I can tell you it doesn't work. It's just, there are things for which markets are powerful tools, and there are things where it's not the right tool. Remember that old adage that to a man with a hammer, everything looks like a nail, and you start banging screws and banging things that the tool is just not suited for it. So I think an important part of understanding the financial system is understanding when it is the right tool and when it's not the right tool. So when are market systems the right tool and when are they not? It's a much more difficult question to answer. And I think another thing that's important to understand about economics, finance, and market systems, we like to think of, the free market, and no, government shouldn't get involved and what have you. And honestly, that's a bunch of BS. Governments are always involved. We wouldn't have the economic system we have if government did not get involved, right? We wouldn't have the amount of stock trading. We wouldn't have a system of currency. We wouldn't have contract law. We wouldn't have so many of the underpinnings that we take for granted in our market system if there was no, basic level of governance. And it's why it's so difficult sometimes to do business in places and countries where there isn't this basic level of governance, where government does not work, where contract law doesn't work, where, there's corruption, where all of these things. You need that, because at the heart of the economic system, and this is one lesson I want you to take away really strongly, because it helps you understand everything else. At the heart of it is trust, right? If you do not trust, you do not transact. If you do not believe that the piece of paper that I'm giving you is a US dollar or a currency of your local government, you will not transact. This is why counterfeiting is such a damaging, thing, is that it erodes trust. If you do not believe in contract law, if you do not believe that, laws will be upheld, if you do not believe a million different things, you will not transact. It's a reason why we have a Securities Exchange Commission. If I do not believe that the data and the information that Microsoft is telling me in its annual report, how will I make an investment in Microsoft? How will I know? I'm not going to be, in the boardroom understanding the financials of Microsoft. I don't have access to that. And the reason we do transact, trillions of dollars on stock markets is because there is, we believe, an overseer. And you can argue whether it's good or bad or working well or could be working better. But government brings in that trust. So government bringing that trust is fundamental. And it's actually kind of like buried in the language of finance. So we talk about debt as credit. You have credit at a bank. You have a line of credit. The word credit comes from the Latin credere, to believe. If you don't believe, you don't transact. It's hidden in the language. It's hidden in plain sight. So trust and belief is incredibly important. And that explains to you why you have like credit rating systems, which we'll talk about, why you have all these other systems designed to bring and increase trust in the system. So how does this apply to conservation? Well, some time ago, a study was done sort of saying, well, how much money do we need to achieve some of the main conservation goals done by WWF with Credit Suisse and McKinsey? And they said, conservation investments, think of that as like, kind of private conservation finance, was giving us somewhere on the order of $10 billion, right? And government investments, philanthropic or other conservation efforts that are not private business or what have you, was putting in 41 million. This is like setting up national parks, doing that kind of thing. And they said, to do everything that we want to do, we need about 300 billion. So we're 350 billion dollars short, right? And they were arguing that much of that is actually going to end up coming from the private sector rather than from governments. But the point I want to make is that, yeah, 300 billion, or the shortfall, 250 to 350 billion, that sounds like a lot of money until you put it against the size of the financial assets out there. So, you know, this is data from back in 2014. So a while ago, right? And things have grown since then. And it sort of says, what is the size of financial markets out there? And it puts together, you know, everything that comes through debt, everything that's in stock market capitalization. So the value of all the companies on stock markets, which is that top 69 up at the top on 2014, the stock market capitalization. By the way, everything else below that is debt. But this is amounts to close to 300, not billion, trillion dollars, which means 300 billion is a tiny, tiny sliver of that. It's, you know, let's assume that that gets us 90% of our conservation goals, the 350 billion. Maybe it gets us 70, whatever it is. That is not a lot of money for the global financial system. And by the way, note that stock markets and equity, so we think a lot of the value is in the value of Apple and Microsoft and companies in stock markets. No, a lot of the money that's floating around the world is in debt. And we in the conservation world never pay enough attention to debt. Even in the sort of so-called ESG world or investment in financial, we don't pay attention to debt. And debt is supremely important. It is several times bigger than equity, right? So where do we go from here? Like, how do we change and fix the system? I think that we need to move from what in this chart you might call classic investing, right? Which is sort of saying, all we care about is profit maximization. All we care about is making more money. And that's on one end of the spectrum. And then on the other end of the spectrum, you have traditional philanthropy, which sort of, it's not about the money, they're giving the money away. It's about what impact does it have? And I think what's interesting about the world we live in today is that there's so many things in between those two extremes, right? There's a lot of different ways that you can mix and match having a return on investment and achieving an impact goal. And, you know, in one simple way, you can just sort of say, I'm going to look at all my investments, make sure they don't cause harm, sort of screen for, you know, do no harm, as it were. On the other, you could try and blend the two returns, impact return and financial return. Or you could say, I'm more impact or more finance, and you can fall anywhere in that spectrum. And I think in today's world, we have different players falling all across that spectrum. Interestingly enough, here in the US, we've had a backlash against ESG, which stands for environmental, social, and governance, which is all it's saying is we need to look at environmental issues, social issues, governance issues when making an investment. And yet it's created a tremendous backlash, partly funded by oil companies, but that's a story for another day. So, you know, there's different ways you can do that. And I think there's hope because we're in the midst right now of the greatest generational transfer of wealth in human history. That is, there's at least 30 trillion and probably more that is gonna change hands, that is being passed from, call it the boomers, to their children or their children's children. And so whenever money changes hands and changes managers, chances are style of management also changes. And so there's an opportunity for a major change in style of management. I think we have begun to see that. And that's why we're seeing sort of ESG become much more important, why we're seeing socially responsible investing become much more important. All of these things are part of, you know, a generation dying out and a new generation kind of taking control of the wheel. And I think that's part of what's, you know, disorienting to so many people, that there is this backlash, whether it's the political backlash in the United States or the backlash against ESG or whatever it may be. So I think there is hope. Because honestly, we've been looking at value wrong in our system. And this goes back again to the 1600s when Galileo Galilei said, "What greater stupidity can be imagined than calling jewels silver and gold precious, and earth and soil base?" People who do this ought to remember that if there was a greater scarcity of soil, as of jewels or precious metals, there would not be a prince who would not spend a bushel of diamonds to have enough soil to plant the jasmine in a little pot or sow an orange seed, right? So he understood that scarcity drives value. And we are moving into a world where some of these natural systems are more scarce. That in itself will add value, and that value will show up in lots of different ways. And I think you got to keep this in mind when you're looking at what's happening in conservation finance, because whether it's the carbon markets, which are an attempt to put a value on an externality, an externality is growing more and more scarce, which is our atmosphere's ability to absorb our emissions. Or whether you're looking at, debt from nature swaps, where, debt is losing value and it's being swapped for nature, which is increasing in value. All of these things are manifestations of this, of a rejigging of our economic system, a rethink. And it's not the first time our financial system has had that kind of a rethink. For many, many years, our financial system did not take into account risk. So again, key concept when you're thinking about finance. Finance is driven by base human instincts. The two most base and most important ones in the financial world are greed and fear. In the financial world, we call them risk and return, but it's greed and fear. So when greed outweighs fear, you invest. When fear outweighs greed, you don't invest. Another way to think of it is that if your return is high, you can get over your risk. If your risk is high, it's hard to think about putting money in, right? And our financial system, even though it's a central part of what drives investment, risk, fear, we didn't understand how to measure it, how to think about it. And our entire financial system came up with innovative ways, started incorporating measurements of risk, created insurance systems to manage risk, created hedging, created all kinds of what are known as derivatives to manage risk and to put a measure and a value on risk. And our financial system is very different as a result. And I think the next big wave of transformation for our economic and financial system is about incorporating some of these externalities and thinking about how we value them, how we price them. And what's interesting about carbon markets is that they're one of the first global, widespread attempts to create a system or a patch for that, to put a value on that externality. And how it's done in carbon won't translate perfectly for biodiversity or pollination or water or anything else, but there are a lot of things that will translate to all of those other things. And we're seeing it, whether it's, the creation of the voluntary carbon market and the voluntary carbon market integrity initiative, or the task force for climate-related financial disclosures, which tells the groups like the SEC that they need to think about climate. Well, now we have a task force for nature-related financial disclosures, which tries to tell, groups like the SEC around the world, you need to consider biodiversity and nature and how things are valued. So these things are changing, and I think, Galileo way back when saw that too. But, and here's Yogi Berra, modern day philosopher, who said, in theory, there's no difference between theory and practice, but in practice there is. And how do you actually do that? How do you capture money? How do you invest? How do you think about investment? That's difficult. And we're seeing it happen in practice, and there's a lot of difference between that and theory. So, all right, I've spoken for a little long, and I wanted to get into, some way of getting you to think like this, right? Like I see myself going into some form of public service like banking, and that's not a joke. But to do that, we're going to have to look at the tools of finance. But before we do that, any thoughts or questions? And I can't entirely see raised hands, so Nigel or somebody else, if somebody raises their hand, please let me know. Okay. No. Yeah. All right. Okay, so I don't see any raised hands. Does that make sense to people? Does anybody think I'm full of BS? And please do let me know. Because sometimes I think I am. Never mind.
Here. So, I mean, I totally get what you're saying. So you think that we're gonna switch from a like cash economy to something else, or how is that gonna work? Just thinking about the carbon market, right? You get a price per ton of CO2, which is like $6, right? But you're not capturing all the other services, and it doesn't seem like the companies actually value. They just value the ton of CO2, right? So how do we transition to something else, or what would that look like?
I think it's a very good question. I actually don't think we will move from, the use of money. I think money is a very powerful tool. How money works, I think, will change. So, and it has changed many times over the centuries, from like I was saying, seashells to gold to other metals to paper. And now we're in the process of transferring it over to digital records of money. And, whether it's a central bank digital currency or Bitcoin or something like that, we are in that transition. But I don't think the concept of money goes away. I think it's more subtle than that. It's about what and how we value things and where those values show up in when we make decisions, how they show up in price effectively. So if you're going to destroy a wetland or a forest to build, your Walmart or whatever it is you're building, the real price of that destruction needs to show up, and it needs to factor in the equation of, should I invest? Should I not invest? Right now, it doesn't show up. So the price is effectively zero. So, obviously destroying it makes more financial sense than conserving it. I think what's going to change is that equation will shift, and conserving it will one day become more profitable than destroying it in certain situations. Now, where and how that happens, I think it's going to happen not through one major shift like the creation of a carbon market. I think it's going to happen through many, many different sort of micro shifts in how we measure things, what we measure, how those measurements get incorporated into economic systems, how we understand risk. So, you can destroy a mangrove, but that increases your risk of having flooding in the next hurricane. How do we value that and use that as part of our decision making on whether to destroy or not destroy that mangrove? How does the economic system send us those signals? And while I think there's a case to be made that we need to tear the whole system down and rebuild it, I don't think we will. I don't think it's as easy as that, as it were. I think we're going to have to see lots of different little shifts and changes at all levels of the financial system. And when we get to talking about the financial system, you'll see that there are things like, credit rating agencies, which I think are an essential part of this picture, that need to play a role in how they measure value, but they don't currently. But they could. How government says you have to report on your impacts on things, that feeds into risk and return and that risk return equation, so that lots of millions of decisions get impacted by this change in the way things are valued. That's how I think this changes. I don't think we're going to tear the system down and build a new one. Does that answer your question?
Yep, thank you.
And yes, $6 a ton is probably not going to be the price forever. That'll change based on more signals get sent, more value. And then we're going to see some carbon that says you should pay more for this carbon because it has community benefits, biodiversity benefits, water benefits, what have you. And I think we've already begun to see that. It's happened since the birth of the carbon markets. In a book I wrote on voluntary carbon markets back in 2005, we talked about commodity carbon, which was carbon that people wanted just because they felt they needed to have carbon and they were looking for the lowest price. And then what we called at the time charismatic carbon, which is carbon that had other co-benefits and people wanted it, yes, for the carbon, but for other reasons too. And they were willing to pay a lot more for that charismatic carbon, even back in the early 2000s. And you got to imagine that the carbon market has only really been around since the 1990s. So, early on in its life, it was already seeing that distinction, and we're only going to see that more. But it's also going to be a lot more regulated or quasi-regulated. So when the carbon markets were born, it was literally the Wild West. People were buying and selling carbon based on word of mouth. The trust was who you knew and how and whether you knew them well. Mechanisms to increase trust have emerged. So registries, standards, carbon credit rating aid systems, all of these things have emerged since it began. So now you have, things like Vera, which is a registry which sets up methodologies. And now we're in the process of building a level of management above that in the Voluntary Carbon Markets Integrity Initiative and the Integrity Council for the Voluntary Carbon Markets. Again, why? Because the system runs on trust, and trust has been lost in the system. We need to find ways to deliver trust. So we create these mechanisms to do that. So I think we'll see a lot more of that. Any other thoughts or questions? All right, so we will move on to talk about money, debt, equity, and the various institutions that use them. And again, if you take nothing else from this, think a little more deeply than I think most people do about money and what it is and how it works. The general definition is something accepted as a medium of exchange. But why does it have value? How do we give it value? I spoke about frozen desire. I spoke of it being an energy and attention in our global circulatory system. But in a way, it's a collective fiction. We're saying, I will trust that this piece of paper is backed by the US government, the UK government, the Colombian government, whatever it is. And that today I can, receive it in payment for a good or service, and tomorrow I can use it in payment for a good or service. Again, this is a radical shift in the way humans have been doing work. And it's not, it hasn't been around as long as you think. Certainly paper money hasn't been around as long as people think, though it's been around a long time. But how do we get there? How did we get to the point where we have that level of trust in the system that this piece of paper has value? And how do we assign value? And where does it come from? So, we see money, some of the first ones, basically electrum coins. The electrum is an alloy of gold and silver from Lydia in ancient Greece, 2,700 years old. We see King Darius of Persia in 500 BC, creating these coins. So we came up with this, over 2,000 years ago. And it's evolved. We have these Chinese spade money or knife money from 600 to 200 BC. Lots of coins over the years. Here's probably the first example that we have in recorded history of paper money. And the way we got to paper money is also interesting, because it's emerged a couple of times in our history. This is one of the first in China. And the way it emerged was that China had those coins I showed you before, right? And the reason they had a hole in them is that they would be strung on a string so that you could easily carry them, right? But, metal has a problem as a store of value, because once you start getting into big enough quantities, carrying around that metal is difficult. So what the Chinese came up with was saying, all right, you deposit your metal in a vault for storage. We will give you an IOU signed by somebody credible. Again, there's that trust mechanism. And that IOU can be transferred so that whoever has this piece of paper, it's like a coat check, right? If you have the right coat check, you can get the coat, right? Well, in this case, if you have the right piece of paper, you can get the metal. But it became just so much easier to carry around the paper and to transact the paper than all the hundreds of pounds of coins that people just transacted the paper, and the metal stayed in the bank or in the vault, and the paper was transacted. And hundreds of years after the Chinese came up with this, the same thing happened in Europe, right? And in the goldsmiths of London would do the same thing, right? Goldsmiths worked with gold. They would make jewelry, they would make ornaments, they would make whatever they made. So they needed to have vaults to store their gold. And people started saying, hey, can you hold my gold for me and give me a little piece of paper? So again, same thing ended up happening. People started transacting the piece of paper. When governments get into this game is a little later, although in China it started, but then it stopped for some actually pretty interesting reasons. This is in the Tang Dynasty in 800 AD. These were certificates issued by the Tang government to pay local merchants in different parts of the empire. And each certificate could be, redeemed for metal, cash at the Chinese capital. And this happened continually, even in the Song Dynasty in 960 AD, and then by the year 1000, government had taken over what had been issued at the time in 900 by merchants. So the merchants were essentially creating the money. They would hold the cash, issue the paper it was done on. They had confidential marks against counterfeiting. This, in many ways, the creation of this paper money led to a little bit of a tech revolution in China at the time. It allowed resources to flow at a very different rate than even metal money had. And you had the creation of movable type, magnetic compasses, the first mega cities. So, cities that were in the hundreds and hundreds of thousands of people when cities in Europe were in the tens of thousands, right? There was even some funny, examples of this, of the creation of restaurants, right? Which was a huge thing, and no other place in the world had it at the time that China had it, where you could go in and order whatever you wanted. And there's accounts from the time of people, marveling at this incredible convenience that it was to go in and tell somebody to cook for you. And then, the government took over. Even the first records of it that many Europeans saw of paper as money came from Marco Polo, who wrote about, visiting parts of China and Mongolia and having seen this paper money and, writing about that. In fact, when he wrote about it, he said, "You will never believe what I saw in China is people using paper for money." And people were like, "Oh, that's crazy. No way that could happen." Right. So these things emerged as a way, again, the token of value. It's actually a digitizing of value. And it unlocked tremendous potential. The Mongols and Genghis Khan used it. They had treasure vouchers, which were accepted basically around the world. One of the first global quote unquote currencies were the treasure vouchers of Kublai Khan. And they were accepted everywhere, quote, at the peril of death. So if you didn't accept this currency, agents of the Khan would come in and essentially kill you, right? You even saw some interesting things happen where the Khan started to try and finance his invasion of Japan by printing more of these treasure vouchers than he actually had treasure. Some of the first instances of inflation. And inflation, again, is this interesting situation when, again, since scarcity drives value, the more you print of money and the more value it has. And it's not that, people think, oh, it's because it's not backed by gold. Well, gold has no intrinsic value. It has a value that we give it. Yes, it's useful in some things, like it makes pretty jewelry and it can be used in some sort of industrial applications, but it would never have the value we give it now, just based on, its beauty, its scarcity, or its industrial applications. It has a different value, and it has a value because it serves in our cultures as a store of value. And the same with this paper, but if you print too much of it, you get inflation. And even with metal money, you had inflation, right? You had people clipping the coins and taking a little bit of gold from each coin and then making a new coin. That was the way inflation happened before. So the coin, which said it weighs a certain amount of gold, didn't weigh a certain amount, which is why people lost trust in the money and started having to weigh the money, and created more friction in the system, and inflation even in metal money. And what's interesting to note about the Chinese experiment with money is that it was lost in the 1300s. And it was lost because a new dynasty came in, pushed the Mongols out, creating the Ming dynasty. In a way, it was a kind of make China great again movement. It was a movement that said, what we really need is less of the cities, less of bureaucracy. We want more, of the rural farming that always made China the place to go. Abolished paper money. By 1400, paper money was gone in China. No overseas trade, much more looking inward, much more isolated. So to the point where China became much more impoverished. So, I think to me, it tells you something about the power that money as a tool unlocks in society. It has a tremendous potential peril in the sense of like inflation or all the things that we blame money for, but it also has tremendous potential to unlock creativity, unlock value. And when you get inflation or you get deflation or you get other aspects of money not working correctly, value becomes locked again. Bitcoin, maybe it's a new global currency. What's interesting about Bitcoin is that it doesn't rely on government as the arbiter of trust. It relies on cryptography as the way that we create trust. We trust that there will be no more than 22 million Bitcoin ever issued because the algorithm says so, and the program will stop it once the 22 million Bitcoin is issued. So, oh great, this is scarce, value goes up. But again, why does it have value? It's because people believe it has value. Any money, any form of currency is that collective fiction that if we believe it has value, it has value. If we don't believe it has value, then it doesn't have value. It's a self-fulfilling prophecy. And any of you were watching Silicon Valley Bank and the run on the bank, again, same process at work here, right? If you believe you're going to get your money out of the bank, it stays in the bank. If you believe that you won't get your money out of the bank, then trust is gone. You go in, you try to get your money out, and you probably can't get your money out because too many people have taken their money out. So, that's a really basic way of understanding money and thinking about it differently than I think a lot of people think about it. The other most important tool in Wall Street is debt. Now, we all intrinsically understand debt, I think. You lend me $100, I pay you $100, but I also pay you a little bit more in interest in order for you to lend me the money. So it's a key concept. I think what people don't understand is that bonds that we see on Wall Street are effectively debt. So, the way to think about a bond is that it's a debt across many people. So let's say you want to borrow $100. Yeah, you could borrow it from one friend, but sometimes getting that amount of money might be difficult. So what you say is, maybe I'll borrow $10 from 10 friends, and that'll be easier because giving up $10 is easier, right? So a bond is that done in the millions or billions of dollars by corporations or governments. So rather than borrow $2 billion from one person, which will be difficult, they split up that $2 billion and borrow it from hundreds, if not thousands, of lenders around the world. And the bond is essentially the piece of paper that says, I borrowed $1 million from you and your interest is 10%. And that's why it's known as a bond. It was because it was a bond to pay back, and it had a form of paper. Debt plays a very important role in the financial system. As we said, it's way bigger than equity. There's more debt in the world than there is equity. More money flows in the form of debt than equity. And that's partly because it's safer, right? When you buy a share in a company, your hope is that it will go up. Or, you want to own a piece of the company. Equity is ownership in a company. But you can lose it all. Its money can just disappear. Debt is different because you expect to get paid back. And if not, you trust that there's a government or a legal system where you can basically go after the person that borrowed money to get your money back. And it has a hierarchy in our financial system. So if a company goes bankrupt, its debts get paid first before any stockholders, any equity gets paid back, right? So they have primacy in our financial system that has. And there's a bunch of people, Ray Dalio, who is one of the founders of one of the biggest hedge funds in the world, who likes to talk about debt eating equity. In other words, debt is more important, has primacy, and when things go badly, it will take all the value out of ownership equity. So key things to remember about bonds is you have the par value, the face value, which is the amount of the loan plus the interest. But debt can be sold at a premium or at a discount. And can anybody think of why a debt would be sold at a discount or a premium? It's hard to see if anybody wants to talk, but just speak up if you want to. Essentially, it gets paid at a discount because you do not believe that the debt will be paid back. If you don't believe the debt will be paid back, or that the risk of getting not paid is high, you'll say, I'll take, I lent $100, I'll take $95 because a safe 95 is better than a risky 100, right? So that happens all the time in the market. And that's when you see, people talking about bonds trading at a premium or a discount. It just means people are paying more than their par value or less than their par value for them. Maturity is when the principal is due, i.e., I'm lending you $1 million. In 5 years, you pay me back $1 million plus interest. Generally, interest gets paid over time, and then the principal is due at a certain time. The markets talk about the coupon of a debt, of a bond, and the coupon is really just another way of saying the interest. And oftentimes you hear financial markets talking about the interest in terms of basis points. And a basis point is effectively 1/100th of 1%. So 100 basis points is 1%. So if somebody says the interest on a debt is 400 basis points, that's 4% interest on the debt. And so they say, whatever, it's risen or dropped by 5 basis points, 10 basis points. You also see it when you're paying financial advisors, on money they manage for you. They charge you generally, and you see it in basis points. And that the word coupon comes from the way bonds used to be. So this is a bond from way back when for the state of South Carolina, saying 100 pounds sterling at 6% interest. And the way it worked was saying, okay, there's a maturity, a date where you're going to pay me back my 100 pounds sterling. In the interim, you have, this is a 1, 2, 3, 4, 5, 10-year debt. Every year, you clip one of those coupons, take it to the bank, and they pay you that year's interest. And that's why we call the interest the coupon on a bond. So when you hear about coupon, that's effectively what they mean.
I have
Again,
a question.
Yeah.
Back to the discount, bond selling at a discount. I thought that the one advantage of, well, and by I think, I mean, I know nothing, but I thought that bonds were supposed to be pretty secure, like a risk light way of investing. So I'm not clear on why they would ever sell for a discount, since you would expect to get it back.
They are generally a lot less risky than equity, which is why people talk about them that way. But it doesn't mean there's no risk. There is still risk that you will not get paid back. So the person will run away, they'll declare bankruptcy, and all their debts go away. There's risks you won't get paid back, right? Or you want to use your money to buy something else, and holding that money, the interest it's paying you is lower than the interest you can get somewhere else. So you're willing to sell it at a discount and move your money. So there's a lot of reasons why debt sells at a discount, but it can sell at a discount. It is still less risky than shares, than equity, right? Because generally speaking, people go, well, the US government is going to pay me back on those bonds. The US government is not going to disappear tomorrow or go bankrupt or whatever. Whereas my investment in a company could, or the value of the shares of a company could easily go to zero. And even in a company situation, let's say I lend a company $1 million, or I invest $1 million. If the company goes bankrupt, I still am first in line to get paid once the company sells off its computers, its any assets it has. The debt will get paid before the equity gets paid. Does that make sense?
Thank you.
So it's less risky. And because it's less risky, and remember, risk and return are correlated, that's why bonds pay less interest or less return than, generally speaking, shares. Right? Because you're taking a higher risk when you buy a share in a company, you expect a higher return. And the higher the risk you are expecting, the higher return you're going to want to make an investment. Your greed has to outweigh your fear. And since your fear is greater, the greed has to be tapped greater. And this is an important lesson in conservation. Why? Because you can play around with risk and reward in any financial transaction. So these are the two dials you have to work with when affecting how money flows. Turn up the risk means people will not invest or will require more interest or more return to invest. Turn down the risk, the opposite happens. Turn up the reward, and the more likely that investments will happen. Turn it down, less likely that it will outweigh the risk inherent in the transaction. Even if you're in the government, this is the way you help channel money. You can increase the risk or return profile. And it's why when things like inflation happen, you play with interest rates. And that's one of the only tools governments really have to addressing things like underinvestment, inflation, things like that. They increase the reward. So Brian put a note in the chat about risk. Sorry, I'm not sure what that was about, Brian, but hopefully you can let me know, or I can move on. So again, the point is that the global bond market is huge. You know, it's in the $120 trillion range, if not more nowadays. So it's very important. And remember this chart of the global financial assets. Everything below stock market capitalization is a form of debt, whether it's the corporates or the governments or securitized or not securitized. Securitized means that it's turned into a security. In other words, that you're turning it into a way to take a debt and you turn it into a different type of security, either equity or something else. Yeah, bonds are discounted risk, absolutely. Correct. So, all right. Does that make sense in terms of bonds and debt? So here's another way to look at it. This is the US bond market, debt versus US stock market capitalization, adjusted for GDP in trillions of dollars. So you can see that for most of our history, you know, stock market capitalization was only a fraction of the total debt outstanding. So again, when you think about finance, don't just think about ESG, which is essentially largely about equity. Think about debt and how we bring conservation issues into the debt market. So I think that'll be important. One important thing to understand about how bonds interest is set is what's known as the rating of bond. So there are what are supposed to be third-party independent credit rating agencies out there. Two of the biggest are Moody's and Standard & Poor's. And whenever a company or even a government goes out to raise money through debt to issue a bond, they will rate the bond. And their rating systems are here. You know, Standard & Poor's goes from AAA through AA, all the way down to D and C and CCC. And Moody's has a similar system, just slightly different. And what they're saying is an A is a low risk debt, i.e. the borrower is likely to pay, is likely to have the money, has assets, has paid in the past, all of those things. The further down it goes, the higher the risk. And that means that if you're going to lend them money, you expect higher returns, you expect a higher interest for those debts. And you've probably all heard about junk bonds. Junk bonds are essentially bonds that are lower rated. And, you know, generally junk starts at the sort of BA in the Moody's scale or B double B's in the Standard & Poor's scale. And so that's what people mean when they say junk bond. It just means they're higher risk investments. They're not huge companies where you feel safe they're paid back. They're smaller companies, they're riskier investments, what have you. And remember I told you that there was a change in financial markets on how we think about and measure risk. One of the biggest examples of that was you know, people realizing that the junk bonds were mispriced, that you could actually make good money on some of these junk bonds, that the risk wasn't as big as Standard & Poor's and Moody's and others were saying it was. And so people made you know, huge fortunes investing in junk bonds. And you might have heard of Michael Milken, the junk bond king, and you know, people like that. And you know, they were right. The risk wasn't properly priced in, and those things have changed. He went to jail, by the way, for insider trading, but that's another story for another day. So,
could you please just explain a little bit about the point you made about turning a bond into a security? If you could just highlight that a little more.
yeah, sure. So, what people do sometimes is they say, okay, we have these series of debts, right? Like, let's say we created a debt for everybody who was in the kinship class, and you all owed money for whatever reason. You raised money either to buy houses or create businesses or whatever. And I went and I said, look, there's some interesting things going on with this kinship class. They have certain qualities, they're likely to pay back, and we can segregate the people in the kinship class. These people are more likely to pay back, these are less. Why don't we do something different? Why don't we bundle all their debt, right? And create what's known as a special purpose vehicle, a company that owns your debt. And then we can issue shares in that company. And you can get paid back depending on how kinship players pay back their debt. You've created a new security out of a bundle of different debt instruments. So, generally speaking, securitization is usually done through this creation of these special purpose vehicles, these companies who have only one purpose: to hold kinship debt. In the real world, this takes the form of mortgage. You've heard of mortgage-backed securities. That's what mortgage-backed securities are. It's just a security is just a piece of paper, whether it's a debt instrument or an equity instrument. And so that's why it's called the Securities Exchange Commission. It oversees both debt and equity. So does that answer your question?
Yes, it does. Do you have like a quick example related to conservation, for instance, where that has been done?
Okay. I mean, it hasn't happened, but it could, right? You could say, look, let's create a bond or some sort of instrument for the debt of all of the national parks of the world. Not that national parks issue debt, but just if they could, right? Or if the governments could issue debt that would be paid back by the national park system. And you could say, okay, let's take a look at the different national park systems. You have some in the US, probably more likely to pay back their debt than, I don't know, name your country, right? Nigeria or somewhere else. So what we'll do is we'll take all of the debt from all of the countries, we'll bundle them together in order to pay less interest than Nigeria would on its own by bundling it with US national parks and other national parks, and we'll create a new debt instrument to finance the national parks of the world. And Nigeria will be getting effectively a little bit of a boost in interest rates, so they wouldn't have to pay as high an interest on that debt. Totally fictional, but it could be done. Like, you could do that. There's been very little use of securitization within the conservation world, but doesn't mean it can't be done. It could be done. It's just hard. I think where debt has been used, well, you have what's on the screen now, which is green bonds, right? So people are saying, look, we want to issue bonds where the debt will go to achieving some sort of conservation goal, whether it's, energy efficiency or water efficiency or, even a Prius plant as opposed to a plant for Toyota that isn't a hybrid or isn't an electric car, right? And we'll say, this is a green bond because it's achieving environmental ends. Now, if you can convince investors that they would prefer to have a green bond as opposed to a regular bond, if all other things being equal, that means you can pay less interest for a green bond than you would for a plain vanilla non-green bond, right? And this is happening. So that example of the Prius, Toyota has issued green bonds for its Prius ones. The city of Washington, D.C. has issued green bonds to pay for green infrastructure as opposed to gray infrastructure. City of San Francisco has issued green bonds that it pays back through energy efficiency, solar, other things like that. So wind energy. So green bonds are a real thing. And, the question is, are they truly green, and who decides? And will investors be willing to pay a premium i.e. receive less interest in return for lending money for a green bond. Up until, I would say, 2 years ago, that second question hadn't really been answered. So people were issuing green bonds, but they weren't paying less interest for them. What they did have was they were selling their bonds quicker, which is valuable to an issuer, right? If you can convince people to lend you money easier, that has value, and that was what green bonds, the value green bonds were delivering. Now there's a lot of studies out there that show that we may actually be seeing what some people have called the greenium, the green premium for issuing a green bond. So while there's not a huge amount of examples of securitization for conservation, there are a lot of examples of debt being used as an instrument for conservation. And probably the one you're most familiar with are debt for nature swaps. So what is a debt for nature swap? A debt for nature swap is essentially a country whose debt is trading at a discount. So, you know, some people have lent money to, I don't know, Argentina, to pick a country. And, you know, people are worried that Argentina is not going to pay its debt, or they've threatened to default on their debt. So the people who own that debt say, you know, Argentina owes me $1 million. I'll take 900,000, or I'll take 100,000. Some of the debt trades that at pennies on the dollar. So, you know, I will get rid of this debt if you give me pennies for what the dollar's worth, and then it's your problem to try and get the dollar out of Argentina. So what do conservation organizations do? Well, they go and say, all right, Argentina, we'll go and buy your debt at pennies on the dollar, because Argentina can't go and buy its own debt. But the Nature Conservancy could. And they go, we'll buy, let's say you owe, you know, let's make it round numbers, easy to understand, $100. We'll buy your debt at $10. And in return, we will cancel that debt if you put $50 towards conservation in Argentina. That is the basic structure of a debt for nature swap. And, you know, you can add all kinds of bells and whistles about how the money flows, or what premium or discount you give to the country, or how you structure it, or how many people are involved, or anything like that. But at its core, that they all follow that same kind of approach.
I have an example from a project that where we use green bond. Can you hear me, Ricardo?
Yeah, go ahead.
We have a company, we work on an island of the coast of Sumatra, and we have a foundation and a for-profit company. So the idea is they complement each other. One's more the economic engine, one's the traditional conservation activities. In our first round of finance, we were raising mostly from family and friends. And one of those was an individual that was interested in the green impact bonds or junk bonds, and using us as an example to scale that. So in our first round of investment, family and friends put in sort of $50,000 to $100,000, and it was 2/3 equity, 2/3 this green bond. And the green bond finance was set up so that a portion of that went into our urgent conservation activities in the landscape, and then the other portion was seeding finance in the company, and then the repayment rate on the bond was 10%, but that was split in terms of what went to conservation and what went back to the bondholder. Over time, it hasn't played out, and we ended up converting it to equity, and other debts being sold and discounted, and all sorts of things have played out. But yeah, it's been really interesting to play around with some of those tools, and I still believe it was a really good thing to do. It was just a little bit ambitious.
Mm-hmm. Yeah. No, I think there's a lot of different ways that we can think of how to use debt creatively and for conservation, and everything from, you know, how do we finance conservation minded businesses, all the way through to debt for nature swaps, all the way through to green bonds. Maybe one day we will see a proper securitization being used for conservation. We have seen securitization being used for social issues. So, you know, taking debt from underserved communities in the United States, turning it into a security and selling it to people. That increases the amount of money and borrowing that underserved communities can do in the US. So, it's about getting creative once you understand the tools and how they work.
People like being involved in creative solutions. Like, that was our experience anyway. People were quite interested in it. It helped us raise money in a way that wasn't people donating money. They were perhaps more inclined to invest in something that was a debt.
Yeah, for sure. And, I've been involved with this group called Blue Forest. I think you might be hearing from Zach, who's one of the creators, so I won't try and steal too much of his thunder. But, the idea behind that was, you have wildfires in the United States. The US government is constantly essentially borrowing from fire prevention budgets to pay for firefighting budgets, because every year the fires are worse, so they have to send more teams out. They don't have the money. They take the money from what they would normally use for prevention of fires. So how do we use debt to change that around and borrow from future firefighting to pay for fire prevention today? And that was the original concept. It's morphed a lot since then, but the current concept is saying, all right, one thing we can do to prevent fires is clear out the underbrush and thin the trees and do proper forest management. That costs money. The US government has to pay millions upon millions of dollars to do that. What if we could go to the government and say, we will find somebody to put that money up, and we will lend you the money effectively and do the work, and you pay us back. And the reason it's palatable to you is, it costs you $100 an acre to do it. Well, we can charge you 90. How will we charge you 90? Well, we will go and borrow money to put up the $100. Then you will pay us 90, and we'll get a water company, which also gets value from less forest fires because they don't get sedimentation in their dams or whatever. We'll get them to pay us 20. Right? And 90 plus 20 is 110. We'll pay our investor 110 for the 100 that we borrowed. So, creative use of debt to address wildfires. And they've raised now, going on 50 million or more to do that. But Zach will tell you more about that. So there's lots of different ways you can get creative with this. Let's skip over sort of green bonds, sustainable bonds, and jump into equity. So equity is effectively a unit of ownership. If you own a stock in a company, it's basically a paper that says you are part owner of the company, and that entitles you to part of the profits of the company. So, it's, as we said, much more risky than debt, because if the company goes under, they don't have to pay you anything. There's nobody going to go after them or what have you. They're just, you invested in the wrong company. Now, it gets a little more complicated in the sense that most people aren't expecting profits or a piece of the profits from a company when they buy shares in a company, right? That is known as dividends. So whenever a company makes money and returns money to its investors, that is generally dividends. But most companies pay very little or no dividends, and they reinvest their profits in the company. So why do people buy stocks? Because they think they can buy it today for $10 and sell it tomorrow to somebody else for 20. And that's generally how most people think of stocks, right? They are an investment that essentially the value of which is tied to how you believe that company will do in the future. So it's about the future value. Many of you will have heard of IPOs, company going IPO. And what an IPO is an initial public offering. That means it's the first time the shares of that company is being sold to the public, is being sold on the New York Stock Exchange, or NASDAQ, which is the tech-heavy stock exchange, or the Shanghai Stock Exchange, offered generally to the public through one of these exchanges. Before the company puts its shares for sale on these exchanges, it still can issue shares. It just issues them directly to private people or companies or what have you. That is what's known as private equity. So there are public equities once they're on stock exchanges that anybody can buy. And there's private equity, which is before they get to the stock exchange. So whenever you hear people talking about private equity, it just means they're investing in companies that have not gone public yet, that have not had an IPO, right? And there are rules as to who can, at least in the United States, invest in private equity. So the government considers private equity investments risky and complex and complicated. And so they've set up a rule that says that, private equity can only be sold, marketed to what are known as accredited investors. These are investors that, own a certain amount of money or a certain amount of assets, usually over several $1 million in assets, or are making a certain amount of money. Basically saying, we don't want people taking these risks without understanding these risks. It's a bit paternalistic, and people have complained about it because it limits who can invest in what is potentially lucrative private equity, but it also limits the amount of risk that people can be exposed through private equity. Now, private equity, these are, again, shares in companies before they go public. People tend to divide it into different categories. So you have really early stage seed investments, like the first investment in a company, usually what's known as a friends and family round, i.e., you're creating a company and you borrow money from your parents or your friends to make that company happen. Then you have what are known as angel investors. They come in kind of next. It's kind of like the first outside of friends and family investor. And then you have what's known as venture capital, which are high risk investments in relatively new, unproven, risky companies. How does venture capital, also known as VC, work? Well, it works by investing in lots of different companies. Because what happens, maybe if you're lucky, 1 out of 10 of them will make it big and 9 will go bankrupt. But the 1 in 10 will make it so big that it will more than pay off for the 9 that went bankrupt. So venture capital is generally a numbers game. You have to have enough investments to manage your risk through diversification. Hoping 1 out of every 10 of your investments will live to see another day. And that's how generally venture capital works. So how does private equity influence conservation? Well, private equity and venture capital in particular is the money going to high risk, new, exciting ventures, right? Tesla before it was Tesla, Facebook before it was Facebook, all of these groups. And so in many ways, venture capital is putting money into the kind of future we want. There is a new source of venture capital out there known as climate tech venture capital. And there's a great newsletter called Climate Tech VC, which kind of analyzes the space and looks at who's investing in early stage companies that have something to do with climate, whether it's energy efficiency, electric vehicles, regenerative agriculture, new styles of meat, less plastic, whatever it is. In many ways, VCs and venture capital is where you invest in technologies. Then after venture capital, you have what some people call mezzanine capital. These are companies that have kind of proven themselves already, so they're beyond venture capital, they're less risky, but they still haven't gone IPO, and they need money for like their second big plant to produce their electric vehicle. And so there are investors who invest in that. level of private equity. Because they don't want to take the high risks. They're looking for companies that have taken some of the risk out of the equation, may not return as much as pure venture capital, but they're a little bit safer. So the risk return profile is more to their liking. And then, what a lot of people in venture capital or private equity are looking for is what's known as their exit. When do they get their money back? How do they get their money back? Oftentimes it's an IPO. It goes and shares are sold to the public. So the Tesla gets listed on, I forget where Tesla is, NASDAQ or New York Stock Exchange or wherever it is. When it was first offered to the public, investors who bought Tesla for pennies on the dollar were selling their shares for tens, if not years later, hundreds of dollars. So they made a killing, right? So that's generally when you see people saying, oh, an investment in Google in 1990 something of $60,000 would make you a multi-billionaire. Well, a lot has happened in between. And what happens in an IPO is, the company says, all right, we're going to offer shares, and they can create new shares too, right? You can say, instead, I now have 100 people that own my company. I'm going to go public. Now I'm going to have 1 million shares, right? And I'm going to offer those out to the public. That is known for an investor as a dilution event. In other words, if you owned, one of 100, all of a sudden you're owning one of 1,000, you own less of the company, but the company becomes more valuable, so you own less of a bigger pie. You can still make money, even after one of these dilution events. So, the shares are offered to the public. There's a lot more shares out there, but each share is worth more, much more than you paid for your, 1 out of 100 shares. So what is the valuation of a company? Well, valuation of the company is essentially you multiply the value of the shares on the market. So if the shares cost $100, you multiply $100 times the amount of shares that are outstanding in the company. That is a company's market capitalization or valuation. And how do you determine valuation in public equities? It's easy because you know how many shares have been issued and you know the value of the share on the New York Stock Exchange. Multiply those two numbers, you get the market cap of the company. So, when they say Apple is worth trillions of dollars, that's what they're doing. They're multiplying the value of the shares on the market times how many shares there are out there. That is the market cap. Private equity, what is a company worth? It's hard because you don't know, right? So what you do is like, okay, if you sold it to 10 people and each share was worth $10, your company's worth $100 because 10 people thought, your share was worth $10. But, how do you invest in it? How do you do your own analysis of valuation and whether you're getting a good enough deal? This is more art than science. You can look at the assets, you can look at all these things, but at the end of the day, it's a judgment call on value. So do people think they understand equity and stocks and differences between public equities and private equity and venture capital and all that sort of thing? Any questions?
Question here. About the venture capitalists that you said is an interesting actor for us who work in the conservation side because they have higher appetite risk for new stuff like conservation ventures, but also venture capitalists they tend to be a little bit more short term for the financial return for getting their exits. How can we have, more patient venture capitalists in this sector?
Well, it's a tough question because there are all kinds of venture capitalists out there, right? There are some that clearly care about, climate and have created venture capital as a way to support changes in technology that'll help us address climate change. But there are those that couldn't care less and are just investing in climate tech because they think it's going to be a growth sector and they think they can make money. Venture capitalists are not the most patient of investors. There are other more patient investors. But venture capitalists tend to be the ones that take more risk, and they're comfortable taking more risk. So in some cases in the conservation world, that can be a plus, right? New technologies, things like that. But they're also looking to make a return. So there needs to be a mechanism for making return. And, there's a reason why venture capitalists like technology, and that's because technology scales rapidly. In other words, once Microsoft kind of made their software, it costs them very little to make another version of that software, but they can make money exponentially. So that's why it's easy to get a venture capitalist to invest in technology, even when it's an environmental thing, because technology has that ability to scale. The problem of getting a venture capitalist to invest in just generally conservation is the problem we talked about earlier, which is we don't value standing forests the way they should be valued. Therefore, their mechanism for making a return is less clear than selling a Microsoft Windows or Chat GPT, right? So that can sometimes be difficult for venture capitalists. And you have to remember that venture capitalists are taking lots of risks across lots of different companies. And if there isn't lots of different companies across which they can take risks, then they're less interested because, again, theirs is a numbers game almost exclusively. They know that 9 out of 10 of their companies will go bankrupt, but they need one that will be able to make so much money that it will make up for all their other losses. And that often does not describe, conservation type investments. The returns aren't that kind of like knock it out of the park, Google, Apple, Tesla type of a return. And where they are, the venture capitalists are there. That's why they're in heat pumps and enhanced oil recovery and things where they can see how they can make multiples of their investment. So I don't have a great answer for you to how to make venture capital more patient. They are generally not impatient because sometimes companies they invest in take a long, long time to make money. And they hang around waiting for it to make money. So it's not that they're impatient, it's that they're looking for a very specific type of investment where they can make multiples on that investment to cover for the 9 that'll going to go bankrupt of the 10 they invested in.
Great, thanks.
Yeah. So, as we said, there are lots of different ways venture capital or equity is used for investments. Equity is ownership in a company. So whenever a company can address a conservation need, there's the ability to use equity or ownership in that company to do that. And stocks are interesting ways of granting ownership. And you can imagine ownership in not just a company, but cooperatives or other things or other structures that you might want to do that for, or water agencies, or there's ways you can get creative with the use of equity. And as we heard from the example in Indonesia, there's ways that you can mix debt and equity. Most companies pay attention to how much debt have they gotten, how much equity is outstanding, what is the value of their company, what is the value of their debt, all these sorts of things. Now, from a company perspective, what do you think is more valuable to a given company, debt or equity, or does it depend on the company?
Yes.
Sorry, what was that?
I think it depends.
Yeah, it very much depends, because when you think about equity is not something you necessarily have to pay back, right? So in some cases, that's a real benefit, all right? When you're unsure if you're going to really make money or if you're going to knock it out of the park, equity is a good way to go because you may not have the money to pay back your debt. However, if you're pretty confident and pretty sure that you're going to make money, well, with debt, you're not giving up ownership of your company. You have to pay it back, but if you think you can pay it back with interest, then it can leverage what you're able to do. And when people talk about debt as leverage, that's why they talk about it as leverage. They say, because you're borrowing money, which gives you greater ability to do whatever it is you're doing than if you tried to do it with just your own money. So you're levering up your capabilities. Of course, you have to pay it back down the line. It's a debt. But if you're confident that you can pay it back, then debt is often a better way to go. But you're more on the hook in a way with debt. In equity, your company goes bankrupt, went bankrupt, you don't pay that money back. That's why it's a riskier proposition. All right, any questions or thoughts on debt versus equity? So here are the stock market capitalizations in 2018 by country. What are the value of all the kind of public stock markets in different countries in 2018? You can see the US is way up there. Largest stock markets worldwide in 2022, again, similar list. Largest stock exchange operators in the world, and New York Stock Exchange, NASDAQ, then Japan, China. So private equity, here's a sense of how big private equity is in trillions of assets out there. So these, again, not in public companies. Pretty big, but doesn't even hold a candle to debt. Where is private equity? Largely North America and Europe. Those are the private markets fundraising by region. Remember that we talked about kind of like risk and return, gives you a sense of like where the risk and return is in terms of interest. So if there are no more questions, why don't we switch to talking about the different structures that use these markets and what's different about them and how they are. So I think most people instinctively know what a bank is, right? You deposit your money, you're able to take it out, they pay you interest. But I think a lot of people don't realize why they pay you interest. And they pay you interest because they use your money to lend it to other people and get more interest. So, if they're paying you 2% interest and they're lending it out at 4% interest, that's profit for them. And that is why you can have a bank run, because they only have a certain portion of people's money in the bank at any given time. The other portion is lent out to others to make money. So what happens if everybody who puts their money in the bank wants their money back? That is a bank run. They can't get it back in many cases. And so people get worried that, oh, I'm going to be the last in line and I'm not going to get my money back. So I'm going to go quickly and go fast and panic sets in. And that is essentially what we saw with Silicon Valley Bank, right? There was a bank run. People started saying, ooh, they're having trouble. They're not going to be able to give me my money back. I'm going to take my money out. And it became a self-fulfilling prophecy, right? It's not that the bank didn't have money. It had money, it had assets, it had lent out money. If people were waited for that money to be returned, there wouldn't have been a problem. But because they didn't wait, they had a bank run. And bank runs, we've seen them many, many times in our history. It's the reason why the US government has what's known as the Federal Deposit Insurance Corporation, which tells depositors we, the government, will insure your assets, your deposits in a bank up to a certain amount. I think it was raised, it used to be 100,000, it was raised to 250,000. So if the bank goes under and you had up to 250,000 in the bank, we, the government, will pay you back. And the reason they did that was to prevent panic and prevent bank runs. So if you have somebody basically saying, okay, you'll get paid back no matter what, why do I have to run to the bank? I don't have to run to the bank. If anything happens, the government will pay me back. What happened in Silicon Valley Bank? Many of their depositors had much more than 250,000 in the bank because they were serving, tech companies and startups, all of which were keeping all of their assets in the bank, so millions of dollars. And they're like, okay, the government will pay us back 250,000, but whatever's beyond that, we're not going to get back. So let's take our money out to be safe. And they created a bank and Silicon Valley Bank. So that is kind of the theory of a bank and how a bank works. The reality is that there's lots more that banks do. Yeah, there are kind of retail banks that take your money and lend money, but they also created asset management, so they invest other people's money. They also provide consulting services to companies on their finances. And that's what's known as an investment bank, generally. There are banks that do that investing, advising, etc. After the Great Depression, the US had a rule called the Glass-Steagall Act, which essentially said, you cannot be both a commercial bank that takes people's money and lends it out and an investment bank, because that's too risky for the commercial side, right? You're investing people's money, you can lose it, you can take big bets, it'll affect, regular people who have their money in the bank. And there was, for many years, essentially a Chinese wall between investment banks and commercial or retail banks. That was repealed, I forget when, Clinton era, I think. And now you have huge conglomerate banks that are both investment banks and commercial banks and retail banks and do it all together. That's where you get, Citigroup and JP Morgan and HSBC and all of those. Before there used to be two separate sections of the bank that were doing different type of work. All right, unless there's any question on banks, mutual funds, what do? They pool people's money in order to give them greater diversification. So they say, great, you want to invest in stocks, but you only have $1,000. Well, that's not going to allow you to invest in lots and lots and lots of stocks. But if you give us the $1,000, we'll pool it with lots of other people. We'll invest that in lots and lots of stocks, and you'll have greater diversification. Besides, we're professionals. We know how to manage money. Trust us, we'll manage your money. That's essentially what a mutual fund is. It gives small investors the benefits of diversification, affordability, liquidity, all that stuff. Of course, to do that, the managers charge a fee. And typically that fee is as a percentage of what's known as AUM, assets under management, typically somewhere between 0.5 and 2%. So they charge you to manage your money. And investors own a portion of what's known as the net asset value, or NAV, of the fund. So if there's, $1 million invested and you put in 1,000, you own 1,000 out of 1 million of the fraction of the net asset value. If it goes up, yours goes up by the same amount. So there's been a shift in the last 50 years in actually investments in mutual funds. So the share of households that own mutual funds has gone from 5% in the 1980s all the way to almost 50% today. So, many households in this country, in the United States, are now invested in mutual funds. Share of the market and the types of securities held by mutual funds. A lot of securities, municipal securities are generally debt from municipalities, from cities, corporate equity, foreign bonds, etc. So let's talk about other types of structures out there. Hedge funds are funds, again, where investors pool their money, but hedge funds are not limited in what they can invest in. They can invest in anything. Anything they can imagine, they can invest in it. They can invest in, you know, equity, public equity, private equity, venture capital, mortgage-backed securities, securitizations, special purpose vehicles, whatever they want. And again, here the government says, these are highly risky, so only open to accredited investors that have assets higher than $1 million. There's been some laws out there that have happened where, you know, the government has said, well, let's open up venture capital and higher risk investments to individuals that are not accredited investors, but let's do it, you know, with guardrails. So there's one called the Jobs Act, which was passed under Obama, which allows certain investments in venture capital by individuals, but under certain very specific rules. Hedge funds can even do a thing called shorting a stock. What's shorting a stock? It's betting that the stock price will go down as opposed to betting that it will go up. How does a short work? Mechanically, what you do is you say to somebody, okay, can I borrow that share you own of Apple and sell it? And I will pay you back later the money that you're owed and a fee for borrowing your share. What happens then is if you sell it at 50 and the share goes down, the value of the share goes down to 10, you buy it back at 10 and give it back to the person you borrowed it from, plus a little interest payment, and you've made $40, right? You've shorted that stock. You're betting that the price will go down. But a short, betting on a price going down is much more riskier. It's riskier than investing in a share. Why? Well, when you buy a share of Apple and you're buying it at, I don't know, what is Apple at these days? Who knows? You know, let's say it's $150. And the most you can lose on that share is $150. You can't lose more than that, right? You can't lose more than your investment. But now let's say you shorted that share. In other words, you borrowed it, sold it for $150. But instead of going down, the share goes up. It can go to 200, it can go to 250, it can go to 300, it can blow beyond 300 and go to 500,000. So your potential for loss when you short a stock is, you know, theoretically infinite, but it could be way more than your actual initial investment, which is why it's much riskier. Now, a lot of people hate short sellers. You know, they think, oh, they're just betting on the death of a company, but they serve a purpose in the system, and that they're sending signals that, hey, we believe this company isn't doing as good as it says it's doing, or as good as others believe it's doing. So, and oftentimes they back that up with research on how the company's doing. So they do play a role. You will remember the Wall Street bets example of how many of you were following what happened with Wall Street bets and the stock of GameStop? What was it, 3 years ago? Did anybody? All right. Then I won't go into the tangent. But what's interesting is that sometimes people sell shares they don't own, and that's known as a non-covered short. You know, in other words, I say, I'm selling you Apple. I don't own Apple. I'm betting that the price will go down and I'll buy Apple at a lower price and make money. That is technically illegal, but we know it happens. So another interesting aspect of shorting. REITs are real estate investment trusts. These are essentially funds that invest in real estate. They're mutual funds for real estate. There are also effectively real estate funds, but for specific real estate that has timber on it. These are known as Timberland Investment Management Organizations, or TIMOs. And I bring that up because they have a really interesting and important role to play, and have played an interesting role in conservation. They own most of the forest in the United States, most of the privately owned forest in the United States. And they have played an interesting role in carbon markets. They have played an interesting role in sustainable forestry, in conservation of private forest lands. And they're essentially fund managers that own a specific type of asset, timberland. Then you have the big money in financial markets. And these are things that people don't often think about. Pension funds, insurance companies, and sovereign wealth funds. So pension funds are funds effectively set up to manage the money that people are putting into pensions, or that companies are putting in for people for pensions, or that states and governments are putting in for pensions. So the biggest, for instance, one of the biggest pension funds in the world and in the United States is the CalPERS, the California Public Employees Retirement System. So these are public employees of the state of California. Their retirement savings are in CalPERS, and that's a several $100 billion fund. How do they pay the pension? Well, they take those several $100 billion, invest it, take returns on the investment, and are able to pay pensions when people retire. They are the long-term thinkers. If you're looking for patient capital, pension funds are generally some of the more patient capital out there. Problem with pension funds is that they have so much money, they can't make small investments. They just don't have the time, the energy, the resources, the people, or the interest to make smaller investments. They're always going to be making much, much bigger investments. For them, it costs the same to make a $1 million investment as it costs to make a 10 million or $100 million investment. And as a result, the transaction costs on, 10 $1 million investments is way higher than one $10 million investment. So you really were not going to get them to invest unless you're in the tens, if not hundreds of millions of dollars. And that's part of the issue with many pension funds. Insurance companies, people often forget about them, but think about what insurance is. Insurance basically collects premiums from, say it's a car insurance or a home insurance. Every year, people are putting in premiums, and many of them won't have fires or won't have their cars stolen, but some will. So they have to pay out when that happens. They take that money in the premiums and invest it. And they're some of the biggest investors in the world. And one interesting thing is that people don't know there's such a thing as a reinsurance company. So the reinsurance insures the insurers. Why? Because insurance is about risk and risk management. So let's say you are an insurer and you're insuring houses in Sacramento, California. Well, if there's a fire in one house in Sacramento, it's possible that fire will spread and hit another house and another house. Those risks are correlated, right? So if you're only insuring in Sacramento, you face the risk of having all these correlated things happen all at once, driving you bankrupt. What do? You take insurance from a big reinsurer. Two of the biggest are Swiss Re, the Swiss reinsurance, and Munich Re, a German reinsurance. And they insure insurers all over the world. So their risks are less correlated. So reinsurers are also huge investors. Sovereign wealth funds are funds owned by countries like Qatar or Saudi Arabia or Norway that make money from things like oil or other natural resources. And they keep that money in a fund, which again, they invest to make money. So I know our time is...
Sorry to interrupt you, but we're running out of time. And I wanted to give like 5 minutes if there are any questions. And then you can go out for lunch and we'll be back in a minute.
Yeah, no, I'm sorry we went on longer than I'd hoped, but I was kind of hoping you guys would interrupt me. But if you tried and I didn't see you, I'm sorry. Any thoughts or questions? I mean, I would just leave you with the sense that, again, the financial system is an incredibly powerful tool. If you understand the tool and how to use it and where to use it and how to influence it, again, using those dials of risk and return, you can do some pretty interesting things with how you channel money to the things you care about and away from the things you don't want to see happen. So I hope this will serve as a sort of appetizer to get you interested in the different ways that finance influences conservation or can influence conservation, and that you will get creative, and like that story we heard about Indonesia, in how you use these tools to achieve your conservation goals. At the end of the day, I think we're going to have to change the way we value ecosystem services and externalities. That is the only way the financial system will become better at managing conservation. So until we do, there are ways we can patch the system, but the system needs a bit of a reboot in terms of our valuation of ecosystem services and externalities. So I'll leave it at that. You know, you can find my email easily there. And if you have any other questions or want to talk about anything, just feel free to reach out to me or give me a call or whatever. And hopefully that was useful.
Thank you.
Thanks so much.
Thank you very much, Ricardo.
We can do it soon.
Yeah.
Good. Okay, ready?
Yeah.